Okay, good day everyone. This is a series that I'm going to start where I try to think about which of two stocks are a better buy, right? Today we'll start with MPACT and CLCT. Right. Firstly, disclaimer, I'm not a financial advisor and this is not financial advice. I may make mistakes and do not guarantee that information shared is all accurate. Opinions I have are my own and for educational purposes only. Right, firstly I will try to value CLCT, which is CapitaLand China Trust. Right, my valuation is based off its NAV as of 30th July 2024. Right, because the third quarter results did not provide an NAV, so I'm going to use the first half results NAV, which is $1.16. Right, I'm going to apply a discount for logistics and business parks because both are doing very badly. Right, this of the 2023 annual report where they say business parks is 17% of their AUM and logistics parks is 7.1% of AUM, so that's a total of 24.1%. right, so I'll just discount 24% from the NAV and that will give me 88.2 cents. This only values the retail side of the business, right, because I'll just consider logistics and business parks are going to carry on dragging and do badly, right, so I just want to buy the retail side. Okay, so retail side, what are the issues? All right, firstly, there's flattish retail revenue. So that means to say, if you look at my last three CLCT presentations, is about the fact that the retail revenue has peaked and I think started to decline. Right, so unless further stimulus is pushed in, right, I expect retail revenue to stay flat or maybe even decline slightly. Right, cost of debt is still increasing, even though they are trying to shift to more yen-denominated debt. Right, so I'm going to apply another 10% discount to this 88.2 cents to give me 79.3 cents. Right, I'm going to apply some more discount for China FX risk. Right, I think this has always been the case for CLCT, whereby there is a risk factor with respect to FX associated with it. That means to say, CLCT, for example, even when it was a pure play Chinese mall, will always command a higher yield than, for example, CICT, primarily because of the fact that they take their revenue in yen and pay out in SGD. So there's always forex risk whereby the yen weakens, therefore you get lesser SGD to pay out. Right? So this has always been the fact that CLCT actually has a higher yield to compensate for that risk. Right? So I'm going to apply a 10% discount because of this risk, also because of the short land use rights applied to their malls, which is about 10 years each, right? They have about until 2024 each, and then they have to apply to extend the rights to use the land, right? So that represents a risk 10 years down the road, which isn't that far away, right? So I'm going to apply a 10% discount further for that, and that gets me 71.4 cents. So this is how I will value CLCT. Current price is 72 cents, so it's I believe fairly valued, right? Yield is 8.4%. Right, this is based off its first half annualized DPU, right, based off the third quarter results, right, so the price 72 cents, yield for the whole year annualized is $6.05, so yield is 8.4%, this is quite good, right, price to NAV is 0.62, right, you get 72 cents divided by $1.16, right, valuation for MPACT, right, I will use, again, NAV, and I will only value MPACT based on SGD assets, primarily because of the fact that in the recent 1 or 2 quarters, all their overseas assets are performing badly. Right? So you can see here, just to summarize for you, the blue color one, the purple color one, the yellow color one, only the bottom 3, which are SGD assets, are performing okay. And even so, you can see that MBC actually has declined. Right, this grey part decline is primarily because they sold Mapletree Anson. All right, so that's not this is an expected decline, so to speak. Right, but if you look at all these, right, the 4 overseas countries that they have assets in, right, are all underperforming, and recently Japan has been giving a lot of issues. So I'm just going to discount these 4 countries, right? China, Japan, Hong Kong, and South Korea. All right, so how to discount that? I just look at the SGD assets, right? By revenue, right, they contribute 60%, right? So the grey, green, and orange, right? This is second quarter results. So second quarter they contribute 60%. First half they also contribute 60%. So I'll just take it as a flat 60% contribution from Singapore, right? So I only value Singapore assets to when I take 60% of NAV, right? And that will give me $1.02, right? and I'll apply a 10% boost to SG assets primarily because MBC and VivoCity I think can command at least 10% above what they hold on book, right? This was actually expressed by the CEO in the last I think AGM, right, where she was talking to shareholders and they were concerned about that, and she said that actually our debt is manageable because our assets in Singapore, especially MBC and VivoCity, are actually undervalued on book. I can easily ask for 10% more, right? So I'm just going to give a flat 10% boost to all SGD assets, right? That means even to the other SGD properties outside MBC and VivoCity, right? And that would mean that I'll boost this number, which is just pure SGD assets, to about $1.12 or $1.13, right? So this is the price where I'll consider to actually buy more MPACT, primarily because also that I already have a standing position in MPACT, right? So the current price currently is $1.21, right? To me at this point is expensive, right? If you look at my previous videos of MPACT, right, I did say that my valuation initially, I think 2 or 3 videos ago, which was maybe 6 months ago, was $1.23 or $1.22. That was when I said I was happy to buy MPACT at that price. But that was when Japan was doing fine, and now Japan is doing badly, right? And it's quite a sudden thing. The last 1 or 2 quarters, Japan suddenly just did very badly. Moving forward, we expect to have more issues and vacancies in Japan's assets, right? So that's why in this valuation, I have to revalue my take towards MPACT, and now I revalued it lower to $1.12 or $1.13. This is where I may again add to my positions in MPACT, right? Year on price is based off is this year, right, which was 11% lower, right? So this is a big drop in the yield in the latest quarter, right? But I analyzed this to get 6.54%, right? So if you calculate yield differently, you may get a higher figure, right? I'm taking the more conservative figure. Okay, price over NAV is 70.7%, but I don't think this really says a lot, right? Right. So anyway, pros and cons, right? I would say CLCT is higher yield, right? If they, I mean, 8.4% is a very good yield for a REIT or trust that I think doesn't have any issues with going bankrupt or extending their debt, which was a concern with some other REITs, like the US REITs, for example, right? They have to borrow at 10% because they can't find lenders, right? I don't think CLCT is in that position if you look at the last presentation that I shared. Higher volatility due to concentration in China risk, right? So MPACT is a bit more diversified. You can see that 60% of the assets in Singapore. So no matter what happens in China, right, that asset in Singapore shouldn't be affected, right? But CLCT is totally in China. So any issues like, for example, tariffs caused by Trump, so on and so forth, that's going to be an issue. But the converse is true as well, that if Trump sort of reaches a deal with China, or China does some boost to its economy by monetary policy or putting money in the hands of people, right, that will boost CLCT a lot more than MPACT, right? So in a nutshell, CLCT is more volatile, right, and in my opinion probably has higher upside, right? One downside of CLCT is I don't know how they're going to spend their money if they sold more malls, right? They did say they plan to sell 2 malls, they are the smaller malls in China, but I don't know what they are actually planning to do, right? And I'll show you why I think their approach is a bit haphazard. If you look at their retail portfolio, it's centralized in Beijing with 3 malls, right? Then Harbin with 2 malls, then the rest is 1 malls. If you look at their business park, right, Xi'an, Suzhou, and Hangzhou, right, of course, you can see that again these 3 areas, right, are not replicated here, right? So you can see that I don't know why they buy in different districts. Hopefully there's a good reason. I'm not very sure what the reason is, right? Then if you look at logistics parks, again, almost totally no relationship with where the business parks or the retail site is, right? The only similarity I can see is Chengdu, where they have logistics and retail, right? Otherwise, yeah, they're all over the place. My concern is that if the people making decisions are sitting in a centralized locations, how much ground knowledge do they have in terms of making good decisions in buying properties in such a widespread region of China? I would find it very difficult to think that, for example, if the central office is in Beijing or Shanghai, right, these people have the knowledge to go around all these areas, right, to figure out where is the best place to buy a good logistics park or business parks, right? Maybe that's why they're buying such poor quality businesses, but also maybe it's a macroeconomic issue, right? I cannot be certain exactly what the issue is in CLCT, right? So MPACT, what are the issues, I think Festival Walk is not sellable, right? It's so expensive. It's like the valuation of VivoCity, if I remember. I think it's something like $1 to $2 billion. I don't like Festival Walk. The good news is that it looks like their rental revisions are approaching zero, which is a good thing considering that the last few quarters at least have all been negative, and some of them quite badly negative, right? So if Festival Walk stabilizes in terms of revenue, it may be a slight positive, but I actually don't like Festival Walk. I think over the long run, prices in Hong Kong have to drop because Shenzhen is such a big competition for them. Japan issues have been very sudden, right? It just came out of the blue, and I do believe looking forward there's more downside expected from Japan. So MPACT does face further headwinds moving forward as well, right? But the good news about MPACT is that 60% SGD located, even though MBC in the latest results has underperformed, I do believe that it is likely to be a short-term issue. Alright, so between the two, which one would I buy in this case? Alright, for me, because I'm a conservative and investor, I'll actually think about buying MPACT, but not at the current price, right? I'll really wait for the price to drop further to maybe $1.10, right? I might even demand a bigger MOS to further my position as MPACT, because I already have a fairly substantial position. It's currently my third largest REIT, I believe, right? And not by choice, it's because the price dropped, right? Luckily, the other two REITs are doing decently well, right? That's why it moved up and MPACT from number 1 become number 3, right? So I would prefer to buy more MPACT, but if I'm a younger investor, right, I would consider CLCT because it provides a higher yield and also a higher upside, right? But with that comes the higher volatility, right? So I think that's all I have to share. Right, please note none of this financial advice. This is just my opinion. Right, yeah, and thank you for listening.